The longer the investor waits on the sidelines for an adverse event to take place, the bigger the adverse event needs to be to overcome the cost of waiting. And it's the same with the decision of whether or not to have equity exposure. A person can wait on the sidelines for the bear market that he or she thinks is inevitable, but the longer that person waits, the longer the corporations are earning profits, reinvesting profits for growth, and paying excess profits out to shareholders. Hello, and welcome to the Evidence-Based Wealth Podcast. I'm Paul Belanger, your host, and author of the book Evidence-Based Wealth. These podcasts contain information and inspiration to help you along in your journey towards financial independence. Before taking action on any of the ideas that you will hear, please note that they may not be appropriate for your particular goals or financial situation. It is always wise to seek the counsel of a certified financial professional to ensure that a strategy is right for you. With that said, let's get this podcast started. Most of the financial news that I've been reading lately has been focused on reasons a person might want to sell their equities. Sharply higher consumer price inflation, the Federal Reserve continuously raising interest rates, Vladimir Putin threatening the use of nuclear weapons, a disastrous earnings announcement from Federal Express, Michael Burry, the Big Short, calling for an epic market crash, and the list goes on. Some other news trumpets the failure of gold as an inflation hedge, and isn't there always a reason to denigrate gold? Still other news talks about a real estate market crash being right around the corner. So what's a person to do? Sell everything and just buy I-bonds and tips? I'm sure my audience would like to hear my thoughts on all of these issues, and I'll certainly be providing an opinion soon on some of the current events. But first I wanted to discuss something much more important. Today I'd like to talk about something that is incredibly important for everyone to understand. When it comes to building wealth, the biggest cost that you will face is the cost of waiting. I don't think the enormity of this cost is appreciated by most people, which is why I'm going to quantify it for you. There will always be an event, or in some cases, just an overblown theory, that will serve as a reason to believe that it's the end of the world as we know it, a reason to just stay on the sidelines and avoid any but the safe haven du jour. I'm certainly not going to shrug off current concerns as irrelevant. However, sometimes I like to reflect back on how some people must have perceived history as they lived it compared to how they felt about it years afterwards. I myself felt a strong sense of fear about events over the past 40 years as I experienced them. The past is full of war, conflict, viral pandemics, assassinations, political scandals, and financial scandals. Let's list a few. World War I was the war to end all wars. World War II, the sequel 20 years later, was larger and far more deadly. Sandwiched in between them was the Spanish flu epidemic that killed between 17 million and 50 million people, according to the historical record. This is far more than the number of people reported to have died from COVID-19, and at a time when the world population was much smaller than it is now. We had the Cold War, a period of multiple decades where people feared that the world could end from a giant man-made fireball. The closest we came to an actual nuclear exchange between the superpowers was the Cuban Missile Crisis in 1962. John Fitzgerald Kennedy, a very popular U.S. president, was assassinated in early 1960s, leaving many wondering what it meant for democracy in the U.S. His brother, Robert Kennedy, by the way, was also killed several years later. And let's not forget about the assassination of civil rights leader Martin Luther King in 1968, during the long-running civil rights struggle, not many months after the violent riots broke out in Detroit. All the while, we had a very unpopular war, the Vietnam War, which led to countless casualties both at home and abroad. Peaceful protests were met with violence. For example, in 1970, the Ohio National Guard opened fire on unarmed protesters at Kent State, killing 4 and wounding 9 others. The Watergate hearings in the early 1970s threatened to remove President Nixon, who ended up resigning. Also in the 1970s was an oil crisis that sent the price of oil sky high and caused long lines where people waited for hours at filling stations to put gasoline in their cars, when gasoline was even available. The AIDS epidemic of the 1980s was a new and scary virus of mysterious origins. Eventually, scientists learned what caused it, and the population learned how to protect themselves from exposure. but I do remember the news stories that suggested that everyone could end up perishing from it. In the early 1990s, we had more race-related riots in Los Angeles, and the latter portion of the 90s saw impeachment hearings brought against what was at the time a fairly popular sitting president. 2001 ushered in the era of the surveillance state, when the Twin Towers, as well as Tower Number 7, collapsed after two jet airliners collided with the buildings. The World Trade Center event was the catalyst for military action and occupation of Iraq and Afghanistan. There's still much controversy surrounding the event and subsequent military actions. In 2008, the money market nearly froze and the housing market collapsed as a result of a long period of undisciplined mortgage lending and bundling of bad loans with good in order to provide a higher debt quality rating than was warranted. In the early 2010s, we had the outbreak of swine flu, which was another H1N1 virus, like the Spanish flu, and the press promoted it as a potential global catastrophe. I could go on and on. We've had many scary events in the past, which at the time threatened the end of the world as we know it. Maybe if fortune hadn't smiled upon us, the world would have ended. Who knows? But think about how expensive it was for those who decided to exit all risk positions to avoid what was perceived to be global calamity. Throughout all of these events, the U.S. stock market, with dividends reinvested, had increased on nominal terms by nearly 2,500 times. The big challenge facing people is, when does it make sense to invest, and when is it best just to sit on the sidelines? If only there was a way to know for sure. Looking back at history, some of the biggest market rallies occurred shortly after some of the scariest events. Who would have thought that a decade that began with near nuclear annihilation and the assassination of a very popular president, one whose signature was race riots and an unpopular war, would be a good time to be in the market? Who would have thought that the decade following the 2008 financial crisis would be so good to the market? It seems to me that the returns offered by the stock market are more a function of how much a person pays for its earnings than what current events suggest about the prospects for earnings growth. Dalbar has reported that over the past 30 years, the S&P 500 has returned 10.65% annualized, but that the average equity fund investor has only earned 7.13%. Now, where did that extra 3.5% go? Certainly some of it has been given up to management fees, but I'd argue that the most of it was missed because investors overreacted to the events of their time. And lest you think that 3.5% is not significant, over 30 years, the average equity fund investor would have seen an investment of $100,000 nominally grow to $790,000. Just leaving the same money untouched in the S&P 500 would have resulted in an ending nominal value of over $2 million. And that's a big price to pay for being reactionary. Of course, this still doesn't answer the question, is now a good time to be in or out? Dalbar's report only focuses on past results. Nobody can buy past results. We can only buy future results. What's the cost of waiting? We need a fundamental way of examining this question. Stocks have a strong element of speculation built into them. So let's start with something that can be treated with more precision. Let's start with bonds and then look at equities. Caution. Bond examples and bond math can be quite boring, but the illustration will be very instructive for the understanding of equities. I'm going to leave out some details for the sake of not putting everyone listening to this podcast to sleep. So if you'd like to see the math, you can check out the article that I just published. We are currently in an environment of great trepidation when it comes to interest rates. It seems that although everyone understands at some level that bonds can decline in value when interest rates rise, only now are people treating this risk seriously. I guess decades of falling interest rates can do that. That is, desensitize a person to risk. I've seen comments from many indicating so much fear about rising interest rates that they would prefer to keep their emergency funds in cash only, like savings accounts or money market accounts, than in anything that could lose value if interest rates rise. How much is a person giving up by doing so compared to a person who's willing to buy, say, a 1-year U.S. Treasury bill? Let's put some numbers to it. Right now, a 1-year U.S. Treasury bill yields 4.1%. Many high-yield savings accounts and Treasury money market accounts earn about 2%. So what is the cost of avoiding any price fluctuations at all? Suppose your emergency fund is $10,000. Option 1 involves the purchase of treasury bills. Now, treasury bills are purchased at a discount and they mature at face value. $10,000 face value worth of treasury bills can be purchased right now for $9,606.15. The remaining $393.85 we'll put into a money market account. When the bill matures, the U.S. Treasury will deposit $10,000 into our account. At the end of the year, how much money will be in the emergency fund? The bill will be worth $10,000. The money market fund will have grown to $401.73, assuming monthly interest was paid. All totaled, this option results in an ending value of $10,401.73. So what about the money market only option? This is option 2. For starters, let's see what would happen if interest rates do not rise over the rest of this year. This will serve to bound the difference in outcomes. If we place the entire $10,000 into a 2% money market account with a stagnant interest rate, then at the end of the year, the balance will be $10,200. Now, this is a full $201 lower than the treasury bill option. Lots of people would say, so what, to the $201 shortfall? Now, I'd counter by saying, that's the cost of a really nice dinner for two. You wouldn't pass up an opportunity at a free dinner for two, would you? Ah, but here's the rub. It's not really a free dinner, is it? The person who buys the treasury bill is taking on some risk, and the $201 is payment for taking on that risk. But what is that risk exactly? It's the risk that the treasury bill will need to be sold on the secondary market to meet the cost of some unknown emergency, and that at that time, the bill will be priced at a lower price than when it was purchased. So how can we quantify this risk? Well, it turns out it's not too difficult to do with fixed income investments, which is why I'm doing this exercise before moving on to stocks. Let's fabricate a scenario. Let's assume that some unexpected cost comes up at the 6-month market that requires all of the money in the emergency fund to be liquidated. Let's further assume that general interest rates rise by 0.5% next month, followed by a month later of another 0.5% rise, and then interest rates stay stagnant after that. At the end of 6 months, the money market, with these assumptions, will have grown to $10,137. How much will option 1 be worth? You know, the option where we had a treasury bill purchased. Surely the T-bill will have lost some value because interest rates have climbed so quickly, and if it needs to be sold at the 6-month maturity, it's natural to assume that the bill would have lost some value, right? It turns out that's false. Even if the 6-month interest rate rises by a full 1%, the T-bill will have a secondary market value at that time that's higher than its purchase price was. Its value will have risen from $9,606 to $9,766, a full $160 increase in value. Why? Well, the answer is that the $10,000 payment is now only 6 months away instead of being a full year away. The T-bill was continuing to do work for us while we held it, even though higher rates are now available on new investments. Now we can compare the two options. Option 2, our money market only option, will have grown to $10,136.53. But option 1, the option where we use treasury bills, will have grown to $10,164.74. Now, despite the rapid rise in interest rates, we'd still be better off buying the treasury bills. Now, we're not much better off, but we're still better off. One could conclude that if interest rates were to climb at a much faster rate than what we used in this example, the treasury bill option might prove to be inferior to the money market only option. But that's a pretty fast rate of increase in interest rates, and the penalty for the treasury bill option won't be very steep. So what's the moral of the story? The moral is that it can be costly to wait for investments to be offered on more attractive terms before committing to them. It doesn't matter if the motivation is to make more money or to avoid losing money. Time is our enemy when it comes to sitting on the sidelines. The longer we have to wait for our predictions to come true, the bigger the gap will be between the safe option and the risky option. One might say that equities are different. Yes, they are. But what makes them so different? The differences stem from the fact that equity does not come with the same contractual obligations. Notice I did not say guarantees. Even bonds don't have guarantees. When you use your money to buy equity, there is no maturity date on which you can expect your principal to be returned to you. An equity is perpetual. You can sell your equity interest to someone else, but you can't know in advance how far above or below your purchase amount that offer will be. Another key difference is that the stream of payments that you receive in the form of dividends is not known in advance. Dividend payments are at the discretion of management and can only be made if cash flow is healthy, which is also unknown. The only certainty is that all equity owners will receive the same dividend payment per share of stock that they own. These uncertainties are what lead investors to demand what is called an equity risk premium. This premium is the annual return investors expect to receive relative to the known benchmark rate of return. Common estimates of the equity risk premium based upon past data is that equity provides an annual rate of return that's about 2 to 4% per year more than 10-year Treasury notes. So if a 10-year U.S. Treasury note yields 1.5%, one might fairly assume that U.S. equities will be priced such that the forward 10-year rate of return on stocks is 4.5%. And what if 10-year Treasury yields climb from, say, 1.5% to 3.5%? Then one might expect stock prices to adjust in such a way so that future expected 10-year returns would be 6.5% rather than 4.5%. Now, there are other factors involved, but in general, we can expect that interest rates will have an impact on stock prices. So now we get to the part where we can draw an analogy. In the emergency fund example, we compared a money market to a very short-term bond. It was shown that an investor could seek to avoid uncertainty, but that choice would come at a cost. The longer the investor waits on the sidelines for an adverse event to take place, the bigger the adverse event needs to be to overcome the cost of waiting. And it's the same with the decision of whether or not to have equity exposure. A person can wait on the sidelines for the bear market that he or she thinks is inevitable, but the longer that person waits, the longer the corporations are earning profits, reinvesting profits for growth, and paying excess profits out to shareholders. The big difference in the case of equities is that there is no approaching maturity date. The analysis that we need to do requires more assumptions and guesswork. Nevertheless, one conclusion that can be reached is the longer a person waits on the sidelines, the higher the opportunity cost will be. An example will suffice to make the point. The Vanguard High Yield Index Fund, or VHYAX, is a fund that I use in my own portfolio for the purposes of generating an income stream. Now, this isn't a recommendation for what you should do with your money. It's only an example. The dividend yield based upon the past 4 quarters is 3.2%. Now, what will be the nominal growth rate of those dividends? Quite frankly, I don't know. But from the beginning of 2008 to now, the annual growth rate has been about 6%. Let's be conservative and assume a growth rate of 3.3%. Now, why am I assuming 3.3%? Well, I'm choosing 3.3% because a 3.2% dividend yield plus a 3.3% growth rate gives an expected long-term return of 6.5%, which is a 3% equity risk premium above the current 10-year Treasury note yield of 3.5%. I personally think that the rate of nominal growth will be higher, but for the sake of this example, I will err on the side of conservatism. If instead of spending the dividends, they are reinvested, and the dividend yield remains constant, we can easily calculate the terminal value of a $10,000 investment after a certain number of years. After 1 year, it will be $10,650. After 2 years, it will be $11,342. After 3 years, it will be $12,079, and so on. But the big risk is that the value of the fund when we decide to sell is unknown, just as is the case with selling a bond on the secondary market. When we sell shares of stock or a mutual fund, the price someone will be willing to pay will be influenced heavily by the rate of return that can be generated by competing investments. Even though the yield available from VHYAX is 3.2% now, maybe someone will demand a yield of 4%, 5%, or even 6% in the future. Who knows? This can certainly happen if interest rates continue to climb and bonds become more attractive. It's not too difficult to adjust the final nominal value for changes in the dividend yield. All one needs to do is multiply by the ratio of the current yield to the terminal yield. Now, this is just a simplification. In reality, the final value will be determined by the path that the dividend yield takes on its journey from its current value to its terminal value. This is because as dividend yields rise, the dividends can be reinvested at ever more attractive rates. Since it's impossible to do an analysis for every possible trajectory, we'll just simplify and make an adjustment to the yield at the very end, as if a sudden change in yield had occurred. Let's consider a really bad outcome where the dividend yield rises to 6%. Now, this is representative of a near 50% change in valuation. If such a change were to occur immediately after our purchase, then a $10,000 investment would suddenly be worth only $5,333. Bummer. But what if such an event didn't take place until year 10? In that case, the nominal value would be $10,011, nearly break even. By contrast, a 10-year Treasury note bought today yielding 3.5% interest would be worth about $14,106 in 10 years if all of the interest can be reinvested at the same rate, which can be achieved, by the way, by buying 10-year Treasury zeros. So, if the dividend yield drops to 6%, an investor certainly would have been better off having bought a 10-year Treasury note. But what if the dividend yield doesn't change? In that case, the $10,000 invested in VHYAX will be worth $18,771 in 10 years. How far would the dividend yield need to climb before an investment in VHYAX will perform similarly to a 10-year note? It turns out the answer is 4.25%. Will this happen? It could. The trailing four-quarter dividend yield did reach 5.5% at the depths of the 2008-2009 financial crisis. But even if this happens again, the nominal value of a $10,000 investment would still be nearly $11,000 in 10 years. Certainly an outcome that's not as good as the 10-year note, but not a disaster either. But what about a longer-term time horizon? Many of us, even some who are already retired, have an investment horizon greater than 20 years, especially if you care to leave a legacy to your heirs. Even if the dividend yield climbs to 6%, and ignoring more favorable dividend reinvestment, the nominal value of a $10,000 investment in VHYAX in 20 years will be $18,800, which is a 3.2% nominal rate of return. In 25 years, it will be $25,748, a 3.9% nominal rate of return. And in 30 years, it will be $35,277, a 4.3% nominal rate of return. The longer a person is able to stay invested, the less important the terminal valuation becomes. I'll say that one more time. The longer a person is able to stay invested, the less important the terminal valuation becomes. A person can still fret over the worst-case scenario and remain on the sidelines, but remember, every year on the sidelines is a year where the corporations you could have owned are generating profits, reinvesting them for growth, and distributing them via dividends. What if you wait for 10 years and your fears are not realized? The status quo case would have $10,000 invested in VHYAX grow to $18,771, compared to a 10-year Treasury note, which will grow to $14,106. Now that's a $4,665 difference, which is a lot of nice dinners out. The future is unknown, and it's unknowable. Equities could certainly continue to decline in price as they've done for the past 8 months. Staying out of equities until the smoke clears may turn out to be the wisest course of action. The future may turn out to be as bleak as it looks. On the other hand, one might consider the experiences of those who have lived through the past 120 years, and how bleak the future must have looked to them. I like to think the record of the past suggests maintaining an optimistic stance with the majority of one's portfolio in equities. After all, we've been through a lot and gotten to the other side. There is a cost of waiting, and that cost has tended to grow the longer a person remains pessimistic. So with that in mind, try to stay invested, keep your chin up. We'll get through it. So until next time, remember, the secret to becoming wealthy is not a secret at all. Adopt a lifestyle that allows you to spend far less than you earn, and invest the surplus in something that will either hold its value or appreciate in value. Keep doing that. Be patient. You'll get there.